Welcome to the Property Perspective podcast. I'm Ari Petrovs, Head of Private Office here in Australia, and I'm here to welcome Liam.
Hi, my name's Liam Bailey. I'm Global Head of Research at Knight Frank and delighted to be here with Ari. Okay, so we've been running the Wealth Report for 20 years. We started in 2007, and actually it's interesting. So if we go back to the first edition of the report that we did back in 2007, we were working with City Private Bank, and they were our partners for the first 4 years. And in that first edition, we'd drawn on a research paper that City Equity Research had done, and it was basically called Plutonomy. That was the idea, and the idea was that the rich are getting richer faster than everyone else, and therefore, if you understand what businesses, services, and so on are selling to the rich, and invest in those businesses, you'll see outperformance. That was our kind of starting point. And just to kind of segue to the current report this year. You move on 20 years, and actually we report this year that the growth in wealth has yet again outpaced kind of global growth. So this idea of concentration, outperformance of wealth is still with us, and it's still kind of, it's still rolling out across our markets. And I guess the relevance of the report is that actually where we started 20 years ago looking at the residential portfolio, that was our starting point, because that was our interaction with wealthy clients at the time. Over the last 2 decades, we've kind of broadened it out to look at commercial assets, look at the private client, and try and understand that kind of whole universe. And I think the rationale behind the last 2 years, we've done this deep dive into family offices. This year we did 40 interviews. Lots of them were in Australia, just to understand where families were going, where the wealthy are investing next. And I find it a fascinating process speaking to the offices, but you're working with them day to day. You're kind of interacting with them. I just wondering whether the trends you saw in the report kind of resonate with what you're seeing on the ground.
I think the most obvious thing is that a family office is not singular with its sector. And ideally for us, not only is it a broad sectoral interest, but also broad geographically. And I think it only stands to reason that the need for capital to be agile for the return profile they seek. Privates are looking in every geography and in every sector, which means the help they're looking for is broader now. And I think that's the fundamental reason why private office exists, is that we should be able to sit across the table from a private family and their representatives and be able to talk about any geography and any sector, big or small.
Yeah. The thing that I find interesting, so I think there is an assumption, and I've certainly heard it many times, that private capital families and private capital can move quicker. They're more flexible than institutions. And I just wonder, is that always the case? Is that how you see it?
No, they decide to go as fast as they want, because they can. So if they want something, of course they can move faster, and that will be their competitive advantage against, the institutional investor. But I would say the one thing you need to be cognizant of is that they will only go at the pace they want to. There is no such thing as pushing private capital to do anything it doesn't want to do. Mm-hmm. They don't suffer from FOMO. They don't suffer from a competitor the same way as institutional capital. And for that reason, I think there's a very different craft and skill set when you provide advice to a private versus institutions.
And you will know this because you're dealing with private clients all the time, but it was a bit of a learning experience for me to actually do these interviews with the family offices. What I found fascinating actually was just, this is no surprise to you, but it's just how different every family was. I found it remarkable to speak with. There's a couple of sports and entertainment clients, and they made money very rapidly, and their office was, to be fair, it was quite embryonic. And actually, when you look at who was running the office, it's often the person who was kind of representing them in that sport, over the last 20 years. It's the person they trust is the person who's representing them. Mm-hmm. That then feeds into actually the risk profile, the strategy they're undertaking, which in many cases can be quite, conservative, because actually there isn't the confidence maybe in some cases with some of the sectors they're moving into. So with clients like that, who are not maybe that sophisticated in terms of the real estate market, how do you sort of work with them in a different way when you're kind of accessing markets?
Yeah, I think there's no one size fits all. So I think very obviously we have to bespoke what service is required. And you're right, there's folk that have had rapid wealth creation, and property is one bastion where they know history says have a decent allocation to that, but what type? And for those that have a higher profile, they are prone to the less astute advice. And they may have, as you're sort of alluding to, they may have some very competent people in the craft, but they can't be expected to understand the full gamut, which is why our business sort of ponies up, if you like, with other experts to provide a very well-rounded full gamut of expertise to the private office, or family office, I should say, in a way that hasn't been necessary in the past. I think we're dealing with, your statistics prove it. We have the most extraordinary growth of wealth in this region, yet most Australians would sort of scratch their heads and say, is that possible? But the means is great within this country, but it's where should we be going?
Yeah.
You will find on the same street assets with very different values simply because they're managed differently and the energy put into those assets are different. We haven't quite seen that. The generalisation that all of Sydney is worth X is no longer the case, the same with every other city.
Yeah. Well, actually, just on your point about Australia's performance, so actually probably for the listeners, the Wealth Report takes a global view, and we look at the whole of the kind of the world of wealth and wealthy people, and we have a wealth sizing model. So we estimate the numbers of very rich people around the world, and we kind of use this rule of thumb, which is basically $30 million or more in net assets is our kind of starting point for wealth. And I think our current estimate is about 714,000 very rich people on that basis around the world. What I find fascinating from this year's report is actually, we estimate that 4 in 10 of those people are in the US, 2 in 10, give or take, are in China, and 4 in 10 are somewhere else in the world. So in many cases, lots of locations are kind of rounding errors in the scheme of things. But actually the Australian market I find fascinating, because our forecast over the next 5 years is that wealth will grow by, let's say, 32%, I think, globally. But Australia's 59%. So actually, I'm sure the listeners are well aware that Australia has done very well economically the last sort of 20, 30 years, but actually that has fed into actually quite an outperformance in wealth, and not just regionally, but actually kind of a global scale. And I'm sure you see that in terms of the wealth coming into your markets.
So since your report was published, I've spent a lot of time trying to explain that 59%, because unless you have context to your own circumstance, it doesn't feel perhaps as profound as the statistic. Yes, we're an affluent country. I think for a long time, Australians have been accumulating wealth but not feeling wealthy. The 30 plus million is a different category, but there's an extraordinary number of high net worth individuals, over $1 million. If you are fortunate enough to own a property, you're more than likely in that category. So we've had very good times for a very long time, but we've also enjoyed the spoils of that. I think the diversity of how we're creating wealth is less understood as well. We've got a very buoyant technology sector that's been creating very rapid wealth, much like other parts of the world. We have some of the wealthiest folk coming from our property industry through successive generations of smart investment and growth. And then we obviously have the mining and resources sector, which has created absolutely extraordinary wealth for a small group, but they are largely ecosystems of their own that create wealth hubs. And you put that together and the statistics actually make more sense.
Yeah, no, I agree. I think it's quite unique actually, because actually the fact, you've got wealth coming out of primary industries, manufacturing plus services and tech. And actually, I guess, the American experience, it's funny, I was in New York 2 weeks ago launching the Wealth Report, and it's just, it's a fascinating environment because, the country is a kind of machine for kind of generating wealth. And it's, I guess, the attitude in America, or the kind of cultural attitude around risk-taking, and actually failure is not failure. Actually it's something which people should try, and if you fail, doesn't matter, you try again. I wonder whether, do you think the Australian mindset is as sort of pro-risk, do you think?
I think we dream about what the US does. Australians often export their smarts. And you could say perhaps our government's taken that attitude with what we dig out of the ground, but we don't have the population base. So our ability to be very front foot, we may have the attitude, but it's a very fine line. That's not to say Australia is unique, but it's a 30 million population, but spread over a vast area. So, our bigger cities of 5 million plus people, you've got a 5 million pool in which to get it right.
Yeah.
And if you need buyers or you need activity and funding from another state, it's going to another country in some respects. I'm being a bit dramatic, but it can't quite be like the US where the statistics are overwhelmingly in your favor because the pool of customers is so big.
Yeah.
So I think we have the attitude, but certainly in the property industry, it's not a haphazard way of doing business now, whether that's industrial, retail, residential, commercial. There's no ability to be laissez-faire about the business case behind anything at the present moment.
Just think about property and sort of allocations then. So one of the things I get asked every year when we produce the report, clients will say, okay, what's the next sector? What's the new thing that everyone wants to get into? And I find it, this is your world. It's not my world in terms of day-to-day commercial property and looking at different sort of asset classes. But I find it interesting that everyone seems to be very interested in the latest thing, the newest sector, whether it's kind of life sciences or whatever. But actually, when you look at the data, actually most investments are relatively traditional. It's offices, it's kind of logistics, it's retail, etc. Is that do you find that it's there is a desire to explore new sectors, but actually the liquidity is actually in the other sectors?
I think liquidity is a whole nother topic, and it is related to the core question you have. But I think what you're asking is, do the private families mimic what the rest of the industry does in property? And the answer is more than likely they do. So if we take data centers at the moment, there's a voracious appetite for everyone to get some exposure to it. I'd say the more astute private clients are looking where they can either be trading in those heady times or finding the crumbs of value around the mainstream. I think for the most successful in property that are private, they've had a degree of counter-cyclical behaviour about them. They're selling at the peak of the market or they're buying at the bottom of the market. Really obvious statements to make, but they're keeping a keen eye on where things are a little bit overinflated. I think the default position for any large family is they will have an allocation across sectors. The concentration risk is a challenge. Unfortunately, with the way the market has gone in this country and other parts of the world, we've had real diminution of value on certain asset classes where even if your house was perfectly in order over decades, the world has changed. Occupancy is changing. We haven't even touched on what AO is likely to do with some occupation of office buildings, for example, but it's not as easy as it was perhaps before, where you could just leave an asset alone. Now, the caveat to that is if you don't have any debt, then you can ride storms. But if there's any leverage in an asset, which is typically the smart way to go about it for private and institutional, some folk have found them in situations where the old business model is no longer contemporary. And that's the changing nature of advice. I think that's where what we're doing is we are trying to provide the most cogent, authentic advice, which often means saying, no, don't do something.
Which actually, that's the advice that people want and they trust, because if actually saying don't do the deal is kind of rare, but it's probably what you want to hear.
And it's the very big difference to the nature of how we need to go about private office activity, because we will lose clients by taking a more gung-ho approach. We need to think of this in decades of relationships, and Knight Frank's is the perfect example of decades-long relationships with high net worths where trusted advisory has paid dividends for repeat business.
So the Australian market is obviously very compelling, or has been very compelling over recent years. But have you got private clients here who are looking overseas, are looking internationally at opportunities?
I couldn't speak to a volume of it. I think there's a curiosity. I think there's a barrier of practicality, which again, that's something that we are attempting to help them with, which is, our tentacles around the world with our small private office dedicated team. We can chaperone you into different markets. We've had extraordinary briefs in the last 12 months where we're after valuations in the middle of Puglia, and we can help on something like that. In terms of large-scale capital investment, I think there will be more familiarisation activities that we will do. We were planning up until recent global events to sort of chaperone some private, larger-scale investor developers to go to the Middle East to meet equivalent private capital. That's very much like a recce. And in time, I suspect, as we help groups to entertain those markets, which is really setting the statutory framework for them, the legal environment for them, there's a lot of unfamiliarity. But yes, in Australia, our clients do look at the tantalising opportunities of value elsewhere in the world, but they're also sensibly cautious, and therefore it's not in vast number. I think markets like New York have become a place where certainly global private capital has found that as a safe place. Friends, family, colleagues have done it. There's a well-trodden path. They can head into those markets, but there are vast swathes of opportunity in the broader part of the world that Australians don't get to. If I brought it back down to very much our day job here in this country, moving capital from, say, Melbourne to Sydney and Sydney to Melbourne is actually the more immediate challenge, because believe it or not, that's not that common. But the market's presenting opportunities right now.
But in a sense, it doesn't surprise me, because actually it's opportunity cost, isn't it? I mean, it's bandwidth. You've got whatever operation you have, and I know that families are getting more sophisticated and they've got bigger operations, but actually to move into a brand new market, it takes a lot of time and skill to kind of learn about those new markets.
I also think that we have to acknowledge that privates have invested in various platforms over the last years that has found their way to do either debt products or equity products, and they haven't all gone swimmingly. And that's very much, I wouldn't call that blind investing, but it's closer to blind investing. I don't think we're going to see blind investment at the scale that we may have had before, or at least how I define blind investment. So whilst a private understands they need to go up the risk curve and therefore go upstream to the opportunities, if they don't have the body parts to manage those opportunities in the way that they're used to, it just represents a risk that has to have a return profile that may not match that opportunity. And that can be the difference between, private Melbourne money wanting to make its way to Sydney. If they don't have the people on the ground, it's enough to say, well, I'm out. Even though the opportunity is so obvious.
Just think about where we are in the market. So, obviously, conflict in the Middle East means that energy costs are up, inflation's a bit more sticky, rates obviously here are kind of leading in terms of the rate cycle moving up. So the market's got a little more difficult. And I think, there's a couple of quotes from the family office survey we did, I thought that stood out to me, which is this kind of an acceptance that the market won't save us, in the sense that actually yield compression probably isn't around the corner. So actually, and there's a great quote from one of the families we interviewed, I think was actually Australian, saying, think about sectors to invest where demand is inevitable. And I think it's a very nice kind of sentiment. Think about structural opportunities in the market. Just about the office market. So you talk about AI and the kind of some of the headwinds in the office market. If you've got families with, with legacy kind of secondary offices and so on, what are they doing? What's their options at the moment?
It can be very challenging for them. And it depends which city we're talking about. If we're talking Australia, the East Coast used to be something you could generalise about, and there was great similarities. I think other than for a relatively similar cost of delivery, and there are differences, but relatively similar cost of delivery, the disparity with rents, incentives and yields has never been more turbulent and different. So what does that mean? If you are unable to keep up with occupants and their demand, then your inherent value to your property, which is income, is really challenged. Some privates will be able to switch the lights off and say, I'm not entertaining the dizzying numbers that occupants are after, but the listed space is leading the charge. So you actually have to keep up. So it's a very expensive game. If you add another 10 years to a cash flow, you've got a good chance that your asset will repair itself, but it's no longer set and forget. And the arms race that now exists to attract occupants is arguably overcooked, but it is what it is. You can be the lone person standing with your arms up to the tsunami of a movement, but unfortunately, you're going to get swamped.
On these, there's another area that I thought was quite interesting in the report. So we've talked in the Wealth Report for a couple of years about the kind of the experiential economy and the kind of the rise of luxury hospitality. Has had a great moment for the last sort of 2 or 3 years, and a number of the families we spoke to, just there was a sense that they would like more exposure to that luxury hospitality world, and they're very interested in things like, say, private members clubs, wellness and so on, all of these areas. Is that something which you see sort of day to day, and actually are these sectors which just require that much more complexity of skills to actually execute.
It's funny, we talk about it very honestly, some of us, that Australians have a sort of 6-star taste on a 4-star budget. So I think there won't be anyone in Australia that doesn't want exactly what you're talking about. And I think one of your quotes in there is the health hedonism that's going on. It's real. I don't think it's just an Australian thing, but people are looking for more and more service. The question is, who's prepared to pay for that? And if we come back to the office sector, in order to attract the best occupants now, you need an extraordinary array of things. And it's going to creep into other sectors. I think industrial will probably be the only one where a health club, and a day spa right next to the front door of the shed may not be anytime soon, but
give it time.
Give it time, perhaps. But the residential space, occupants, and particularly in build to rent, the most extraordinary array of amenity now exists to satisfy an occupant, and that capital being the income.
Yeah.
So it's an expensive craft to be an owner of property. I would like to believe that Sydney's leading the charge of how economically that can work, because Sydney's in a rarefied space in Australia where its income against some of these assets is globally at parity, which is extraordinary when you compare it with some of these global cities. But I often describe Sydney as the parcel of land that seceded from Australia and swims alone amongst a global group. And it really does. Its maths is very, very different. It's very difficult to replicate what you can do in Sydney in the other states.
Well, it's interesting actually. So we talked about it in this year's Wealth Report, but we do a quarterly report on super prime sales around the world, and I mean, people are interested in what the rich are buying, but I think actually the report, which we track 12 cities and we just count up the numbers of $10 million plus US dollar sales, and it was interesting that in Q4 last year, Sydney, I mean, to your point about actually Sydney's global relevance, in this particular market, I think it was 5th globally in terms of numbers of super prime sales. But actually, from my observation on that is all of the other markets that are above Sydney, I mean, they're all very global markets in terms of their buyer profile. Now, I know that there are global buyers coming into the Sydney marketplace, but it's much smaller. It's just this is a much more domestic-driven market, and actually to have Sydney outpacing London in the final quarter of last year was remarkable. I mean, it points, to be fair, to challenges in London as well, but it also, I think, it resonates with your point about actually Sydney's performance at a national level, but also its kind of its performance, globally.
Oh, it's extraordinary. If you focus just on the residential sector and we look at new build and higher end new build, if we start from the south and head north, Victoria will call its prime apartment market probably 17 to 20,000 a square metre, which is uneconomical. Brisbane is the 25 plus to 35 ideally, and it can achieve that for the right product. Sydney's in another league altogether. The broader statistics that take in most of Sydney will say it's a sub 40,000 a metre, but we have product in Sydney that's 50, 60, over 100,000 a square metre, which puts it in that global category of specialness. Now, Sydney can command that, and different parts of Australia can command that because it's trophy real estate. The harbour is very special. London is very special. New York is very special. Sydney deserves that, and other parts of Australia do as well. But the disparity is enormous.
Yeah, it's interesting actually. With you mentioned the harbour, and I think actually this is something which I think is quite interesting in the luxury residential space, because when you have certain markets like Sydney, where you've got a very established luxury sector, this developed over decades, and it's a little bit similar to the London experience, where I was talking to a number of branded residence developers who were kind of thinking about coming into the London market, and ignoring some of the headwinds we've got. If you've got a good product in London, you'll sell it. There is still a depth of demand there. And one of the guys I was speaking to, he said, look, the problem with London versus other markets like Dubai or Miami is if you're trying to sell a luxury branded kit, but in many cases what you're selling is a newer product than what is there in the market at the moment. It's newer, it's got more facilities and so on. That's what stands out. But he said, look, how do we compete with a Notting Hill Garden Square? That is a unique proposition that has been there for 150 years or whatever. They're amazing, they're beautiful. And I think it's similar in the Sydney context, that actually if you're coming here, this isn't Dubai where you're building just another tower that's newer than the last one. Actually, you've got something really tangible to compete with, which is this, and the harbour and the kind of the luxury suburbs and so on. That's a global standard in terms of accommodation. So I think it gives a challenge to those kind of developers that actually they've got to step their game up even more.
I couldn't agree with you more, and I think we've got to be careful, and I think we are careful because we're practitioners in the space, but you can't generalise the way we may have been able to previously. Within the same suburb, at 36,000 feet, it may look the same, but it might be that corner or that particular address within that suburb is the one that will work at that price, and there'll be great disparity in price on another.
Yeah.
And that is the challenge to navigate for any form of capital, but I think private capital is very much aware of it. They are in behind a number of these residential products, and there is a big difference. Some groups have extraordinary brand that will drag the clientele because they have that quality, as you say. Others are too opportunistic and the value proposition may be different. But I think it leads to this point that no matter the market, trophy assets will always be trophy assets. And certainly the ones that don't trade, I see that's where they will always trade, and private capital will always hunt something that is, we probably overuse the term, but can be held intergenerationally because it's special. And most cities of the world will have something special. They will always transcend whatever market's happening. And I think that's what we'll observe in this country.
Just sort of bringing these thoughts together, and our time is limited. So a couple of themes that I saw in the family office survey this year, and I wonder whether they speak to your experience. One is, I guess we called it a growing sophistication from families, more willingness to kind of co-invest, actually come together as groups of families to actually access bigger schemes, more complex schemes. I mean, are those themes you're seeing?
Look, that's one of my dreams, is to do a lot more matchmaking with private capital. I think inherently privates don't really like the idea of partnering, but one thing I'm sure of is that they are least excited about partnering with REIT money. So I think if going forward opportunities are only possible where there is a shared form of risk on assets, but they want exposure to it, I do see that privates will club. We see that in broader capital stacks where very good managers are very good aggregators of private capital. And as a number of them say, they don't want to be so much in that capital stack that they feel they need to have a seat on an advisory board or a board and have to have sleepless nights about their percentage. So many of them are quite happy being 10 to 15% or lower. But they want exposure to the right assets. And we've just started to see that managers that have knocked down properties in public processes, single families going in and investing and being the single source of capital in what otherwise would have been hundreds or tens of investors. So I do think we'll see it on the larger assets, because when you look at the allocation for what is very substantial wealth, property will always be there, and smaller assets can be as difficult to manage as the larger ones, but with the less multiplier on against it.
Final question. So slightly more, a little more challenging environment. Rates are obviously going the wrong way at the moment, but if you look ahead next 12 months, what are you most excited about in terms of opportunity?
Okay, so I think there is lots of opportunity in Australia, but Australia needs to very sensibly go through what it's going through now. We have a change in monetary policy. If we didn't have distractions of change in legislation, we have a proven path of how we start to risk adjust sensibly for property. And we're going through that now with the potential for more interest rate rises. We're dealing, particularly in property, with some foreshadowed changes, quite substantial changes. And what that's actually going to do is just have a lot of pumping of the brakes happening across the whole market. What's that going to do? It will slow things down, the volumes will reduce. As I say to privates when they ask the question, Ari, what would you do? I say, well, you're not going to get rewarded for your bravery at the moment, but have your money ready to go. And I think that's the only sensible advice we can give now. But there's a lot of buying in Australia already at replacement cost or better than replacement cost. I'm now 32 years in this industry, so I can speak with some reference to the past. If you can buy at those levels, I think the key filtering you need is, why will that asset survive and win the talent war of occupation and income? And if you can unlock that, there's very good buying.
Excellent. Thank you so much.
Thank you.
Ari, thank you for all your support on the Wealth Report.
No, thank you.